In March 2023, the 16th largest bank in America failed in 48 hours. It held $117 billion of bonds, United States government bonds, the safest asset on the planet. Those bonds killed it. In 2022, the safe half of millions of retirement portfolios lost 13% of its value in a single calendar year. The worst performance for that asset class in recorded history, going back to 1976. People didn't lose that money on crypto. They lost it on bonds. And right now, the market that caused all of that is the same market that set your mortgage rate this morning, calibrated the interest on your car loan, determined what your savings account pays you, and quietly predicted whether your employer is about to start laying people off. You've been living inside this machine your entire adult life. Most people have never once looked at it. That changes today. By the end of this video, you'll understand the bond market at a level that most financial advisors don't bother explaining to their clients because their fee structure doesn't require them to. I'm going to show you the exact mechanism that cost retirees billions in 2022, the precise math linking a bond you've never bought to the mortgage on your house, and a single number that has correctly predicted every US recession since 1955. Not most, every single one. Here's the metaphor that will anchor everything I'm about to show you. The bond market is the calibration dial on every dollar you own. When that dial turns, every financial instrument in your life turns with it. Your mortgage payment, your bond fund, your savings account interest, your stock portfolio's valuation, and the likelihood that your company still exists in 18 months. The dial is always turning. Most people don't even know it exists. The ones who do are the ones who stop being surprised by what happens to their money. I'm going to call it the dial throughout this video. Every time I mention it, I want you to picture a single large knob, the kind you'd see on an old amplifier, and know that every financial event we discuss is just that knob turning up or turning down. Let's start with what a bond actually is, because the definition matters more than you think. Someone needs money. A government, a corporation, a city. They don't want to borrow from a bank, so they borrow from you. You hand over a fixed sum called the principal. In exchange, they promise you two things: a fixed interest payment every year called the coupon, and your original principal back on a specific date called the maturity date. That's the entire instrument. A legal piece of paper that says, lend me money now, I'll pay you interest every year, and I'll return your money on this specific future date. The United States government is the world's largest borrower of this kind. As of June 3rd, 2026, total US national debt sits at $39.2 trillion. That number loses, meaning fast. So here's a frame that keeps it real. The Congressional Budget Office projects that interest payments alone, not the debt itself, just the annual interest, will total $1,039 billion in fiscal year 2026. That's more than the government spends on Medicaid, national defense, or total non-defense discretionary spending. Divide $1,039 billion by 365, and you get approximately $2.85 billion per day just in interest, every single day. The dial is very expensive to maintain. 5 years ago, the average interest rate on the total marketable national debt was 1.485%. As of May 2026, it sits at 3.386%. The debt didn't just double in cost because there's more of it. It doubled because the dial turned. That's the first time the calibration metaphor matters in this video, and it won't be the last. Now here is the single rule you need to hold in your head to make sense of everything else. When interest rates rise, the price of existing bonds falls. When rates fall, the price of existing bonds rises. They always move in opposite directions. Always. No exceptions. This is not a market phenomenon. It's arithmetic. Here's why. Suppose you buy a $1,000 bond, paying 3%. That bond sends you $30 every year. A few months later, rates rise, and the government issues new bonds at 5%. Those new bonds pay $50 a year on the same $1,000 face value. Now, you want to sell your original bond Nobody will pay $1,000 for a bond paying $30 when they can pay the same amount for a new one paying $50. The only way to sell your bond is to drop the price until the $30 it pays represents a competitive yield. At 5%, that math lands at roughly $600. You haven't lost any future payments. The bond still pays $30 a year and returns $1,000 at maturity. But on paper, right now, your $1,000 investment is worth $600. Every disaster I'm about to describe in this video is that rule operating at larger scale. The calibration dial turned, the price adjusted. In a few minutes, I'm going to show you exactly how this broke the retirement strategy that every financial advisor sold to every American for 4 decades. But first, I want to show you how this same mechanic is reaching directly into your wallet right now, every single month, whether you own a bond or not. Of all the bonds in that $145 trillion market, one matters more than the others: the 10-year US Treasury note. At the end of May 2026, the weekly average yield on the 10-year Treasury stood at 4.47%. When a bank decides what mortgage rate to offer you, it doesn't invent the number. It looks at the 10-year Treasury yield and asks one question: why would I lend money to a household for 30 years when I could lend it to the US government for 10 years at 4.47% with essentially zero risk of default? The answer is, it wouldn't unless you pay more. So the bank takes the 10-year yield and adds a premium to compensate for the extra risk that you, a human being with a job and a health history and a marriage, might stop paying. As of July 2nd, 2026, the 10-year Treasury note sits at 4.46%. The spread between the 10-year and the 30-year fixed mortgage rate is approximately 1.97%. Add those together and you get the mortgage rate Americans are paying right now. The 30-year fixed rate mortgage averaged 6.43% as of July 2nd, 2026. That number came from the bond market, not from your bank, not from your credit score, from the dial. There's a man I want you to think about. Call him Marcus. Marcus found a house he loves in 2021. He qualified for a $350,000 30-year mortgage. In January of that year, the 30-year fixed rate touched 2.65%. Marcus's monthly principal and interest payment would have been $1,412. Marcus didn't buy the house that month. He waited. He thought prices might drop. He bought in 2023 instead, after the rate had climbed to 7.79% to the peak. Same house, same loan amount. His monthly payment was now $2,500.33. The dial had turned 200 basis points. That single knob rotation cost Marcus $1,091 every single month for 30 years. Total extra cost, $392,760. Nearly $400,000 for waiting, for not understanding what the dial does. Stay with me, because this next part changes the way you think about retirement entirely. For roughly 50 years, the standard wealth management advice in America was this: as you get older, move money out of stocks and into bonds. Stocks grow your money, bonds protect it. A portfolio holding 60% in stocks and 40% in bonds was marketed as the conservative, sensible default, the 60-40 portfolio. The bond half was your seatbelt. And for most of those 50 years, it worked because the dial mostly stayed in a narrow range or moved slowly. Then 2022 happened. The Federal Reserve raised the federal funds rate from essentially zero at the end of 2021 to 4.5% by the end of 2022. That's the fastest rate cycle in 4 decades. The dial didn't turn, it was wrenched. The Bloomberg US Aggregate Bond Index, the standard benchmark for the American bond market, dating back to 1976, had experienced only 4 down years in its entire history, up to 2021. In 2022, it posted a total return of negative 13%, the worst loss ever, by a significant margin. That's the broad index. The broad, diversified, supposedly boring one. Go further out the maturity curve, and the numbers get harder to look at. Intermediate term treasury bonds lost 10.6% in 2022, the biggest decline on record going back to at least 1926. Long-dated zero-coupon treasury bonds, the kind held in certain retirement funds, lost 39.2%. 39.2% on government bonds, on the seatbelt. Add it all up, and a 60-40 portfolio of US stocks and bonds was down more than 16% in 2022. The stocks fell, and the bonds, the seatbelt, fell with them at the same time for the same reason. The hedge didn't work because the thing being hedged had become the cause of the damage. When rates rise, both stocks and bonds lose value simultaneously. The calibration dial doesn't care about your diversification strategy. Here's the important question you should be asking right now. You think the problem in 2022 was bad luck or a one-in-a-generation event. But actually, the problem was a number printed on every single bond fund's fact sheet that almost nobody ever reads. Duration. Duration is a measure of how sensitive a bond or bond fund is to interest rate changes. Specifically, it tells you approximately how much your fund will gain or lose in value for every 1 percentage point move in interest rates. A duration of 6 means a 1-point rise in rates costs you about 6%. A duration of 17 means a 1-point rise costs you about 17%. Same bond market, same rate move. Radically different outcome depending on whether you ever looked at that number. Here's a specific example. Consider a retiree, let's call her Patricia, who has $500,000 in a bond fund she was told was safe. If her fund holds broad investment-grade bonds with a typical duration of 6 and rates rise by 1 full percentage point, she loses $30,000. If her fund happens to hold long-dated treasury bonds with a duration of 17, which some target date retirement funds hold, the same 1 percentage point move costs her $85,000 on an identical $500,000 position. Patricia didn't change anything. She didn't make a decision. The dial turned and nobody had explained duration to her because her advisor's annual fee didn't require them to. By the way, hit subscribe if you find this useful, because YouTube's algorithm may never show you my videos again otherwise. Duration is the difference between a bruise and a broken leg. It is printed on every fund's fact sheet. It takes 3 seconds to find. The fact that most investors who hold bond funds have no idea what their duration is says everything about the incentive structure of retail financial advice. There's also a critical distinction that saves individual bondholders but destroys bond fund holders. If you buy an individual bond and hold it until the maturity date, price fluctuations along the way are irrelevant. Your coupon payments arrive on schedule. Your principal comes back in full at maturity. You can ignore the dial almost entirely. A bond fund is different. A bond fund never matures. It is a basket of bonds repriced every single day at market value. When rates rise, the losses appear on your statement and they stay there. The people who owned individual bonds in 2022 felt essentially nothing. The people who owned bond funds felt everything. Most retail investors own bond funds. Most of them didn't know the distinction. Now, I want to tell you about a bank, because what happened to Silicon Valley Bank in March of 2023 is the most perfect illustration of everything I've just described, compressed into one story. By the end of 2021, Silicon Valley Bank had grown explosively. Tech startups were flush with venture capital money and they parked it at SVB. The bank was flooded with deposits, over $176 billion of them. It needed somewhere to put that cash. During a period of low interest rates, the bank invested a large portion of the influx of deposits into securities with long-term maturities. When interest rates started to rise, SVB did not heed the early signs of market risk and had significant unrealized losses on its held-to-maturity investment securities. These long-term bonds fell in current market value as interest rates rose during the inflation surge. At the end of 2022, the bank had a $117 billion bond portfolio. At that point, its mark-to-market unrealized losses for securities held to maturity exceeded $15 billion. $15 billion in losses on government bonds, bonds called riskless. It would have been fine if the plan was to hold to maturity. Any losses between now and then would only be paper losses. At the maturity date, you receive 100% of your investment back. However, If you need to sell those bonds before maturation to meet liquidity needs, like a lot of depositors banging on the door asking for their money back, then you have a real problem. Those paper losses have to be realized to convert the bonds back to cash. That's exactly what happened. To raise cash to pay withdrawals, SVB announced on March 8th that it had sold over $21 billion worth of securities and realized a $1.8 billion loss. The announcement caused a bank run as customers withdrew funds totaling $42 billion by the following day. $42 billion in one day. From a bank that held United States government bonds, the bank didn't collapse because it owned bad assets. It collapsed because it owned bonds with the wrong duration, long maturities, highly sensitive to rate increases at a moment when the dial moved faster than anyone at that bank apparently understood it could. Silicon Valley Bank's chief risk officer had resigned in April of 2022, right when rates started climbing, and wasn't replaced until January of 2023. The dial was turning. Nobody was watching it. This is where it gets really interesting. And this is where the subplot I mentioned earlier actually lands. Here's the gap that most people never close. Knowing these numbers and actually building a system around them are two very different things. You could watch this video and understand every mechanism I've just described and still do nothing useful with it. That's the problem I kept running into after 10 plus years running my own business, surrounded by accountants and fiscal lawyers who showed me how money actually moves. I understood the mechanics. What I didn't have was a framework that turned mechanics into action. So I built one. I put together a digital book called The Exit Code, 8 chapters built on 50 years of actual retirement data, no filler. The whole thing is a mathematical framework for figuring out when you can actually stop working, not based on feel, not based on a generic rule someone made up in the 80s, but based on your specific numbers. 2 things in the book connect directly to what we're discussing right now. The first is the dynamic withdrawal method, which replaces the 4% rule, a rule that has been quietly failing people for 30 years because it was built on a historical bond market that no longer exists. The second is what I call the lazy portfolio, which has historically outperformed active traders over 30-year windows without requiring you to predict what the dial does next. The whole book costs less than 1 dinner out, through the link in the description. Every year you delay thinking about this compounds against you, not because of marketing pressure, but because of arithmetic. Now, back to the dial. Because there's one more move it makes that functions as the best free recession predictor in public finance. It's called the yield curve. Picture a simple chart. On the left side are short-term treasury bonds, 3 months, 6 months, 1 year. On the right side are long-term bonds, 2 years, 10 years, 30 years. The y-axis is yield. In a normal environment, the chart slopes upward from left to right. Short maturities yield less. Long maturities yield more. The logic is obvious. You should be paid more for locking your money up for 30 years than for 3 months, because 30 years carries more uncertainty. Right now, in July 2026, the 3-month Treasury bill yields approximately 3.71%. The 10-year yields 4.47%. At the end of May 2026, the weekly average for the 10-year stood at 4.47%. Normal slope, normal looking curve. The dial is turned to a position economists call term premium. But occasionally the curve inverts. Short-term yields rise above long-term yields. The 2-year Treasury starts paying more than the 10-year. When this happens, the bond market is making a very specific prediction. It expects the Federal Reserve to cut short-term rates in the next year or two because it expects the economy to deteriorate. According to research published by the Federal Reserve Bank of San Francisco, the Treasury yield curve inverted prior to all 10 US recessions since 1955. 10 for 10. No other single economic indicator has that record. The term spread, the difference between long-term and short-term interest rates, is a strikingly accurate predictor of future economic activity. Every US recession in the past 60 years was preceded by a negative term spread, an inverted yield curve. Furthermore, a negative term spread was always followed by an economic slowdown, and except for one time, by a recession. The bond market doesn't publish a press release when it's worried. It doesn't appear on cable news and say, we think a recession is coming. It turns the dial in a specific direction that you can track in real time for free at the Federal Reserve's own website. The fact that most people don't know this exists is not an accident. It's what happens when financial education is gatekept behind expensive advice, relationships. Now, I want to pull all of this together in a single concrete scenario because the numbers are the point. Meet David. David is 53 years old. He has been diligently saving for retirement for 25 years. He has a $420,000 401k. His advisor built him a portfolio that is 60% stocks, 40% bonds. That's $168,000 in a broad bond fund. His advisor told him the bonds were the conservative part. David never looked at the fund's fact sheet. He didn't know what duration meant. David's bond fund holds intermediate to long duration bonds, duration of 11.2, entirely realistic for a fund that chases slightly higher yields to justify its expense ratio. In 2022, rates rose by approximately 3.5 percentage points over the course of the year. With a duration of 11.2, a 3.5 point rate move would produce approximately a 39% decline in his bond fund's value. $168,000 becomes roughly $102,000. David lost $66,000 on bonds on the conservative part. His stocks were down roughly 20% in the same year, which on $252,000 means a loss of approximately $50,400. His total 401k losses in 2022, approximately $116,400. He didn't do anything wrong by conventional wisdom. He had a diversified portfolio. He just didn't know what the dial was, or that it was capable of doing this. Now here's the kicker. David also had $80,000 sitting in a savings account at a large national bank, earning the FDIC national average. The national average savings rate is currently 0.38%. That's $304 in interest per year on $80,000. Meanwhile, the 3-month Treasury bill yields 3.71% as of July 1st, 2026. The same $80,000 in T-bills would earn $2,968. No additional risk, no additional complexity. T-bill interest is also exempt from state income tax, which means the gap is even wider for anyone in a high tax state like California or New York. David's bank is earning 10 times more on his money than it's paying him, and David is letting them. Financial advisor charges me 1% per year of assets to not explain this to me. There's also a version of David who thought he was being smart by moving into bonds in 2020 to reduce his portfolio risk. At that point, rates were near historic lows. He bought long-dated treasury bonds yielding 1.5%. He felt conservative. He felt prudent. He felt like he was following the advice. Then 2022 happened, and the calibration dial was wrenched upward, and his safe bonds lost nearly a third of their value. The lesson is not that bonds are bad. The lesson is that buying any asset without understanding how price and yield interact is not investing. It's guessing with nice branding. Here's the broader picture that connects all of this, and it matters for how you read financial news going forward. When investors fear a recession, they don't hide cash under a mattress. They sell stocks and corporate bonds and buy US Treasuries. Lots of them, fast. This is called a flight to quality. It pushes Treasury prices up and yields down, sometimes dramatically, within hours of a major economic shock. This is also why, in most market environments, stocks and bonds tend to move in opposite directions when fear spikes. The money leaving equities flows into Treasuries, which acts as a natural hedge. 2022 was the exception that proves the rule. The driver of that sell-off was inflation. And when inflation is the fear, both stocks and bonds get crushed simultaneously because the cure for inflation is higher interest rates, which is exactly what destroys bond prices. The hedge broke because the enemy was inside the building. That is the specific scenario where a 60-40 portfolio cannot protect you. And that is the scenario where knowing duration, maturity profiles, and how the yield curve is positioned can be the difference between absorbing the blow and being blindsided by it. The relationship between bonds and stocks also determines something called the equity risk premium. The 10-year Treasury currently yields 4.47%. If an investor expects stocks to return 7 or 8% over the long run, the premium for taking on equity risk instead of buying safe government bonds is roughly 2.5 to 3 percentage points. That premium shrinks when bond yields rise. And when it shrinks far enough, institutional investors stop buying stocks and rotate into bonds. The 2022 sell-off was not purely about earnings or valuations. It was largely about the equity risk premium getting squeezed as the dial turned. Understanding that one relationship gives you a more predictive framework for equity markets than most analyst reports do. There's one more thing that the bond market offers regular people that most financial advice completely ignores: a direct route around banks that are quietly keeping most of your interest for themselves. Consider this gap. The FDIC national average savings rate sits at 0.38% as of June 2026. 3-month US Treasury bills yield 3.71% as of July 1st, 2026. Those T-bills are backed by the full faith and credit of the United States government. Your bank savings account is FDIC insured up to $250,000. The safety profile is essentially equivalent. The yield gap is roughly 10 to 1. Top high-yield savings accounts are offering up to 5.00% APY as of July 2nd, 2026. The national average bank, by comparison, is keeping approximately 90% of the interest your money generates. If you have $50,000 sitting in a standard savings account at a major bank right now, you are leaving approximately $1,650 per year on the table. Over 5 years, that's $8,250. Not in fees, you can see, just in yield you never collected because the bank counted on you never noticing the gap. There's also a specific inflation protection tool most people skip entirely. The US Treasury issues Series 1 savings bonds. The current composite rate, in effect through October 2026, is 4.26%, adjusted with inflation. The purchase limit is $10,000 per person per year through Treasury Direct. Not huge, but for cash, you want to keep safe and protected against purchasing power erosion. It's the most direct inflation hedge available to a retail saver without any brokerage account or any complexity whatsoever. Now, I want to revisit the subplot I introduced earlier, the one about understanding the mechanism but not having a system, because I promise to resolve it. Think about the typical professional in their late 40s or early 50s who has done everything right by conventional standards. Maximized their 401k contributions, built a diversified portfolio, never tried to time the market, and still watched their retirement account fall 16% in 2022 while being told the bonds were the safe part. The mechanism isn't complicated. The calibration dial turned faster than they expected, in a direction that punished every conventional strategy simultaneously. The gap isn't intelligence. It isn't effort. It's the difference between knowing the rules and understanding the system the rules are built on. The bond market is that system. It prices your mortgage before your bank does. It signals economic downturns before economists announce them. It generates yield your bank would rather you didn't know about. It makes seatbelts dangerous in specific weather conditions. Understanding it doesn't require a Bloomberg terminal or a finance degree. It requires knowing that there is a dial, knowing that it turns, and knowing what to check before you decide where to put your money. 3 things to do before you close this video, not generic ones. These 3 are specific to bonds, and they apply to your actual situation right now. First, find the duration of every bond fund you currently hold. Log into your brokerage account, pull up the fund's fact sheet, and find the duration number. If it's above 7, understand that a 1 percentage point rise in rates will cost you roughly 7% or more of that position's value. If it's above 12, you own something that behaves more like equities than a seatbelt, and you should know that consciously, not accidentally. Second, check what your cash is actually earning. Log into your bank account and find the current APY on your savings. According to the FDIC, the average APY across all savings accounts as of June 15th, 2026 was 0.38%. At the same time, there were a number of high-yield savings accounts offering APYs of 4% and higher. The yield on 3-month Treasury bills sits at 3.71%. The difference between 0.38 and 3.71% applied to a $50,000 savings balance over 10 years compounds to approximately $19,000. That is not a rounding error. That is a decision you are making by default right now. Third, bookmark the 10-year Treasury yield. You can find it in 5 seconds on any financial website. Watch it for 30 days. Every time you read a financial news story about mortgage rates, stock market performance, or economic concern, check the 10-year. You will rapidly develop a read on the calibration dial, not a trading strategy, but a sense of where the machine is set and what direction it's turning. That context is worth more than almost anything a financial newsletter charges you for. Lazy investing built more fortune than crypto memes. The people who got rich in finance didn't get rich by finding the next hot thing. They got rich by understanding where the water flows before everybody else starts looking for the river. As of June 3rd, 2026, total gross national debt is $39.2 trillion. Debt held by the public is $31.6 trillion. The interest clock runs continuously. The dial is always set to something. The only question is whether you know what it's set to, or whether you're going to keep letting your mortgage rate, your savings yield, and your retirement account performance be determined by a machine you've never once glanced at. The bond market isn't complicated. It's just invisible to people who were told it was boring. Word count is approximately 5,050